Are we seeing a stock market crash? Will the US economy fall into a recession? What should investors do? Is this a rare buying opportunity, or is it time to get out of the market? This is a special edition of the Mind Blowers podcast, where we do a quick deep dive into the unfolding stock market turmoil. Yesterday, markets were rattled. The S&P 500 dropped nearly 5% in a single day and is now down around 8% year to date. But the real damage is happening in tech. The Nasdaq took a brutal hit, with major players like Apple and Amazon falling 9 to 10% in just one session. The Nasdaq index is now down a staggering 14% this year. Across the Atlantic, the picture is different. The DAX index in Germany is down nearly 5% today, but despite that, it's still up around 3% year to date. So while Europe took a hit today, it hasn't suffered nearly as much as the US. And then there's China. The Chinese stock index appears almost untouched by the latest developments. It's up about 1% so far this year. Even yesterday, while American stocks were collapsing, the Chinese index only dipped around 1%. Over the past 5 days, it has only fallen about 1.7%. So what's going on? Why are US stocks getting hit the hardest? The trigger appears to be tariffs. Donald Trump has announced sweeping new tariffs, not just on China, but also on EU countries, Mexico and Canada. It's a bold and aggressive move in a high-stakes global economic game. But right now, the US is the one paying the price. The big question is this the start of a full-blown recession? Will tariffs push up prices and trigger a new wave of inflation? Or will they instead choke global trade and drive the US economy into a deflationary slump? And what about interest rates? Will the Fed raise rates to fight inflation or cut them to avoid a deeper downturn? For investors, this is a pivotal moment. Panic is in the air. But history has shown us that moments like these can either be the beginning of a long decline or the start of a major buying opportunity. In the rest of this special episode, we'll unpack what's really going on behind the headlines. We'll explore how these tariffs could reshape the global economy, what it means for markets, and what smart investors should consider doing right now. This is the Mind Blowers Market Flash. Let's get into it. Hello and welcome to the Mind Blowers podcast. Today we're going to talk about geopolitics and also the recent stock market crash that happened yesterday. And with me we have Lars Tvede. Hi, Lars.
Hi.
So what do you read into, I think we can call it a small stock market crash, at least for the tech stocks in the US that we saw yesterday? I mean, obviously it's about the tariffs, but it's interesting to see how it seems to hit US stocks much harder than the rest of the world.
Yeah, that's correct. If you go through all the markets yesterday, a couple of things stand out. First of all, the dollar fell. The American markets was among the hardest hits. It was almost the hardest hit. And the American interest rates fell. So obviously people have been knowing that this tariff announcement would come for a long time. So it has been discounted in the prices based on what people assumed would happen. Goldman Sachs came out with a report a few days before, so-called Liberation Day, where they said that the numbers would be worse and higher tariffs than the market expected. But I think it was higher even than Goldman Sachs expected. So pretty much everybody were taken by surprise, and also the way it was calculated also surprised people. So in the US, you can wonder, so US put tariffs against other nations, and yet US is hit the hardest. And that can seem strange, but on the same day we had some pretty weak economic data from the US. In the US stock market, you have a lot of retail investors, especially in tech, who have had a very good run for a long time. And I think a lot of these bailed out. So it's kind of self-fulfilling process. The other thing is, but this of course applies to to many markets, but it's very difficult for consumers and especially for business decision makers to make decisions about many things when they don't know what the tariffs will actually be, because these tariffs are not supposed to be the final ones. For instance, this morning there was already an announcement that Israel had told the White House that they would remove all tariffs against U.S. Goods and services. Bill Ackman, the hedge fund manager, came out on X and wrote that he strongly advised everybody who were confronting tariffs that they were not happy with to pick up the phone, call Donald Trump, so to speak, call the team and say, listen, can we talk about this? So there will be a lot of frantic wheeling and dealing. But while this happens, it's still very difficult for anybody to make decisions for goods and services that involve these tariffs. So I think it's essential for everybody, including the Trump administration, to get the tariffs to a permanent level. And ideally, there would be many cases where other countries take down their tariffs and maybe also technical trade hindrances against the US. And then the US said, okay, if you take your down, we'll take ours down. So there might even be cases where we end at a lower point than the starting point. I don't know. But it's something, for the UBS wrote this morning that we would see this within the next 3 to 6 months. I certainly hope that it will go a lot faster, simply because it slows down the world economy when you have this uncertainty. For instance, would you make the decision to move a factory from Europe or from Asia to the US to get, to avoid the tariffs, if you are not sure what the tariffs will be or whether they will be there at all? So, yeah, so very important to get this to a level very, very quickly.
So it seems the market reaction, as it is so strong, does not believe that the U.S. and Trump is using the right tactic for this. So do you think that they're simply saying, okay, the turmoil that you just mentioned will last longer, which will lead to a recession? So even though we might end up with lower tariffs in the end, the damage will, so to speak, be done. Is that why we're seeing this reaction in U.S. stocks?
Well, there's damage being done meanwhile. Some of it may not be lasting damage. But yeah, again, there's one thing that's really important to understand about this whole situation for the Trump administration, and that is there's a midterm election in about 18, 19 months. And they have a very narrow majority in the House. And also, first of all, they really don't want to lose that majority, because then Trump becomes kind of a lame duck in the second half of his presidency. But the second thing is that if it's too messy, then there's a risk that a small group of Republican members of the House become difficult, start saying, yeah, we actually don't agree with some of your policy. We want this in return for voting for that. And they're not there now, so there's super high discipline. So he can't just do anything and not care about what happens with the economy in the short term. They have to get the economy working with inflation under control and with a good job market fairly quickly. So they have urgency in everything they do, and they will also have urgency in getting in resolving this tariffs issue, which of course is an issue that they have decided to bring up themselves, but they need to negotiate permanent levels of tariffs as quickly as they possibly can, and then say, that's it. Our tariffs for this country or for this sort of good is at this level, and that's it. And then people can adjust.
So do you think what we're seeing is that the Trump administration have decided to do all the really tough things in the beginning, like things that will impact the stock market negatively, maybe have the economy dive into a recession, and then as quickly as possible kind of turn it around so that the midterm elections, when that time comes, there will be positive news to share?
There was a report recently from JP Morgan where they were discussing exactly that, and they said in the Trump's first term, he did all the nice things first, and then the things that were harder for the economy afterwards. And they discussed exactly that. This time, they're doing the hard things first, and then the nice effects will come later. So some of the things that are hard for the economy, apart from this uncertainty because of tariffs, are that people who are working for the state, either directly or as subcontractors, of course, are feeling a great uncertainty because of the DOGE project. The DOGE aims to cut 3.3% of GDP in annual spending. And Elon Musk, he can only work the way he does on a limited period of time, 130 days. And so he says that by late May, he expects to have found all these cuts. Right now, they have only found about 15% of the target of 1 trillion in cuts. So at the speed they've had so far, it would actually take more than a year. But they would have done it before the midterm elections, at least. But again, this creates uncertainty in some segments of society. The tariff war, as it looks right now, is another factor that creates uncertainty. Then the benefit, the dynamic effects, for instance, dynamic effects where people move production to the U.S. And that doesn't happen in months. That happens in from several quarters to quite a few years. So the benefits come later, and also deregulation has not really been implemented at the scale that we expect yet, but they probably will. But then it will take a while before that really kicks in. And also there's a discussion of moving taxation from income tax to tariffs. But right now it's the tariffs we don't see interest cuts in income tax. So yeah, we're taking the hard part first, and then the better part should hopefully come later.
But why do you think it is that normally when we see there are issues with the US economy, we actually see emerging market stocks performing even worse than the American ones? And this time we actually see quite a lot of stability in emerging markets, and especially in China. How come, as they're one of the main targets, why do you think that Chinese stocks are not declining?
Because even though China is the world's factory and has an enormous export, it's actually because of the sheer size a quite closed economy. So it doesn't impact the entire economy particularly hard. Vietnam, for instance, is another matter. The foreign trade in Vietnam is slightly bigger than its GDP. I know that sounds odd, but that's technically absolutely possible. So for us, as a very open economy that has a very big export to the US as part of its GDP, it's far more painful. So specifically about the U.S., it is as I said that U.S. already have had a slowdown evolving going into this, and it also has all this retail speculation in equities, which is being unwound right now.
Okay, so let's look a little bit ahead. How do you think investors should play this? I mean, I'm thinking, is this kind of a short-term bump, and then we'll see negotiations, and we can expect stocks to go up again, or do you think it will lead to a recession and stocks will be down for a longer while, maybe even continue down?
Well, I think when you see stocks very oversold, technically, it could easily be a buy. And the reason I say that is that now the way Trump acts is that he's very nasty in the beginning. And so that's a way of putting a negotiation anchor and then leaving it to the counterpart to try to drag that anchor in their direction where they want it. So we've seen this again. He comes out with extremely harsh tariffs, and then he leaves it to negotiation for the other ones to get those tariffs down, but he wants something in return. So what I mean by this is that we've seen now the worst of it. in terms of tariffs, and then now we will see good news probably coming out from different countries where tariffs are going down because they have agreed on taking their tariffs down and so on. So it should get the news on that front should only get better from here on. In terms of recession in the U.S., we don't have any, in my opinion, any big imbalances in the U.S. that can create a big recession problem. So it's more a temporary slowdown that we see right now. It can become a technical recession, but it's nothing like what we see, for instance, if there's a huge problem in the property market and so on. So I think it's a soft patch and a buying opportunity. So I can't say whether you should buy today or in 2 weeks or 2 months, but I think it's a buying opportunity.
Okay, so let's maybe just end the market discussion, just talking about what we think will happen in terms of inflation and in terms of interest rates. Will we see the normal pattern here of a slight recession, which means lower inflation and lower interest rates, both in the US and Europe?
Well, first of all, if you take the inflation in the US, historically, there's been no correlation between increases in tariffs and inflation. So we have had, if we go back more than 100 years, we've seen periods of increase in tariffs with no negative inflation, no increase in inflation. And we saw it also under the first Trump administration. There was no effect on inflation when he raised tariffs. Also from a theoretical point of view, economists, economic models say that you might get a temporary spike, but then that will be reversed later. So what happens in reality typically is that, first of all, the exporters absorb some of the shock. So they sell. They don't just raise the price proportionally. Let's say there's a new 20% tariff, then they're just not raising the price by proportionally. They cut their price to make it to facilitate the continued export of goods to America. Second thing is that the importers in America might cut their profits to also absorb some of it. But having said that, the American economy is also very close, like the Chinese. So it's only 4% of retail market in the US is imported. So a 20 or 30% tariff will amount to 1 point something percent if there's no shock absorbers, but there are shock absorbers, as I just mentioned. Then there are, of course, subcomponents. So if you build a car in the US, not so much Tesla, but many of the car producers import a lot of the parts from a lot of other companies around the world. And of course, there might be some inflation going into the subcomponents, which is then reflected in the car price. But also Powell from the Fed, a long time, many economists have said that if there are inflationary consequences, then they are temporary. So this is the US, and I don't think it's so interesting to discuss what are the inflation impact on the rest of the economy, because it's the US which is putting tariffs on its import. And so that is where you obviously first should look for these effects. The second thing is that, so interest rates fell a lot in the US, completely in complete contrast to what many people had predicted. So why, if tariffs are higher than people had expected, why do interest rates fall? That suggests that inflation expectations should be lower, but it's probably growth expectations that became lower because of this. But I think that when this finds a lower level and a permanent level, a number of other things that the U.S. administrations are doing will actually facilitate quite high, or I would say abnormally high long-term growth in the U.S. economy. So so I think growth will not be great this year. but it could be phenomenal in the coming years after that.